Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. From time to time on the podcast, we hold AMA episodes. That is, Ask Me Anything. If you have a question you think is going to be of broad interest, send it in. I'll answer it live on the air. Send your questions to victor@victorjm.com. That's victor@victorjm.com. On today's show, we're talking about a country that's running out of cash. It's no secret that Italy's in financially bad shape. Much like in the U.S., some states are in better shape than others. The U.S. federal government has one extra trick up its sleeve. The feds can go to their friends at the Federal Reserve and ask them to print more money. Individual states can't do that. They're under much greater pressure to live within their means. In the European Union, individual countries that had control over their currencies could print money at will and inflate their way out of their short-term financial troubles. Italy's populist leaders are discussing paying public sector suppliers with IOUs instead of euros, a step that those opposed to European Union controls have proposed as the starting point for a new currency in case Italy has to leave Europe's currency union. The heads of the League Party and the Five-Star Movement, which make up the governing coalition in Rome, want to assess the idea of paying off government arrears with IOUs in denominations as small as 50 euros. Dubbed mini-bots after Italy's BOT treasury bills. BOT is an acronym that stands for Buoni Ordinari del Tesoro, or loosely translated, Ordinary Treasury Bonds. One can debate the instrument. It's a proposal, but the urgent need to pay the tens of billions of euros of public administration arrears to companies and families should be clear to all, said Matteo Salvini, head of the far-right League Party. Italy's finance minister Giovanna Tria has tried and failed to stop the discussion, arguing that the IOUs would be an illegal parallel currency, or they would be an extra government debt at a time when Rome is struggling to rein in its own deficit. So the question simply is, when is a piece of paper considered a currency? Is a U.S. Treasury bill as good as cash? What's the difference between a $1 bill that is essentially a government IOU? It says on the front face of the U.S. $1 bill, Federal Reserve Note, and then goes on to say, this note is legal tender for all debts public and private. Of course, it used to say, this certifies that there is on deposit in the Treasury of the United States of America $1 in silver, payable to the bearer on demand. But that was when our currency was actually money and backed by tangible hard assets. That's an entirely separate discussion. So let's go back to Italy. Italian government bonds currently have yields of 2.35%. That compares with U.S. Treasuries at 2.15%. Considering the additional risk associated with fiscal management in Italy, such a small risk premium seems inappropriate to me. Claudio Borghi, chairman of the Budget Committee of Italy's lower house of parliament, has said such small denomination IOUs could be a fallback instrument for Italy's economy in case of a clash with the Eurozone authorities. Mr. Borghi tweeted on Sunday that the European Central Bank forced Greece into submission in 2015 in a shameful humiliation of democracy. I would like to avoid this to my country. He's signaling that Italy might be headed in the same direction as Greece. European officials last week called for disciplinary proceedings against Italy for flouting fiscal rules. Italy's national debt stands at 132% of gross domestic product and is projected to rise over 135% next year. Among developed countries, only Greece and Japan have higher government debt ratios. Unlike Euro members, Japan borrows in a national currency that it can print. Japan's debt is currently priced at minus 0.11%. Here too, the pricing seems way out of whack. I've been predicting for some time that the next financial crisis will be caused by a sovereign debt crisis that spills into the global financial markets. The signs will appear slowly at first, and then quickly when the realization kicks in that the problem has no solution. The effect of a financial crisis will be a shortage of liquidity and a possible increase in interest rates if the market attaches a risk premium to the debt. As you're thinking about that, pay close attention to what's happening in the financial markets. It could affect your future as a real estate investor. Have an awesome rest of your day. Go make some great things happen. I'll talk to you again tomorrow.